Well, good afternoon, everyone. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by Tyler Maddox with MCA Realty. They are a fund based in Western U.S., and the majority of their portfolio are in the Western states. I believe they're also in Texas as well. So we'll explore all of that when we jump into this. But first, Tyler, thanks so much for joining me on the show.
Great. Yeah. Thank you for having me.
So is that a pretty fair summary based in the Western U.S.? Where states are you in, I suppose, would be a good place to start.
Yeah. We have invested in Texas and Austin in the past. We don't own anything there now. We've invested in Phoenix in the past. We don't own anything. Those are target markets. We currently own uh, assets in Southern California, Northern California. We have a pretty heavy presence in Vegas, Denver, Salt Lake, Seattle. That's all. That's the markets that we currently own assets in. We've owned stuff in Maui, of all places, in the past,
Hmm.
but mostly Western U.S., kind of Texas West. In primary and secondary markets, we probably won't invest in kind of tertiary markets where there's just less liquidity, but certainly the primary and secondary markets, kind of Texas West.
I want to jump into your investment strategy a little bit in a moment here, but first, just a little bit more background on yourself. So 33 years in the industry. You started on the brokerage side and then went into the principal side. I know that covers a lot of territory over 3 decades, but what else can you add to give some color on that as well?
Yeah, now it's 35 years, so it's probably
35.
so
Wow.
yeah, that just indicates my age. I started in brokerage at the predecessor to CBRE, which was Coldwell Banker Commercial back then, and worked in brokerage, industrial, and kind of two-story office and land for a little over a decade. Then in 2001, I had the infinite wisdom to go buy a clothing company and figure out how to lose a fair amount of money in a short period of time, and figured I wasn't very good at that. So that was kind of the catalyst to switch on the principal side. Honestly, I didn't really have anything else to do. So I the first deal I did, I kind of cobbled somebody together from some former client tenants of mine who'd sold a business and kind of wanted to invest in real estate. They found an old building and cleaned it up, leased it, and sold it. And I was kind of in business at that point. And so I did kind of some small private syndications up through 2006 and 7, kind of on my own, just doing everything myself. Some good and some probably not so good. And then partnered with a close friend of mine, who's still a close friend, for a few years, kind of heading into the GFC and then coming out of the GFC, and worked out some of our assets. Unfortunately, we didn't lose any money over that time frame, but we certainly didn't make much. And then I guess around 2010, I just played golf for about a year because there wasn't much to do and I didn't have any money, and and debt was hard to get and the world was upside down. And then we formed this business in 2011, and with two of my partners, and we've been investing, pretty much not exclusively, but primarily in small and mid-bay industrial assets in the Western U.S., the markets we just talked about. So that's been our, the focus of our business. It's kind of a more, the asset class is probably a little more in vogue today than it was back then. And our thesis in buying multi-tenant industrial was, how do we reduce binary risk, for our investors? So it wasn't that we were geniuses. It was just you could buy small white multi-tenant stuff for really inexpensively and fix it up and lease it and stabilize it and either sell it or refinance. And so we did that a lot from 2011 through 2001, or 2020. And then when COVID hit, we decided we're going to raise a fund to take advantage of all the chaos that came out of COVID industrial real estate. And, that downturn in industrial lasted about 4 days. And then, and then the market kind of rebounded and demand really picked up based on, everything was going on with the amount of money that the treasury pumped into the system, and things went crazy for a while. So we didn't take advantage of chaos, but we were able to buy assets at pretty good values, fix them, and sell them. And so we're about 50 or 60% of the way through our first fund. We've round tripped a little more than half the assets, and we still have some that we're kind of stabilizing and preparing to sell. So, and then in 2020, I guess just this year we closed on our second fund in January. Our first fund was 50 million. Our second fund, we have $100 million target. We did an initial close of 60 million in January, February time frame, and we plan to do a second close. Hope to get to 100 million. If we get to 75, 80, we'll probably close and then deploy that fund. Our goal would be to roll out a third fund, call it 24 months ish from now. So that's kind of been our business.
Oh, very cool. You were early to the game going after small and medium bay industrial, at least compared to what some of the guys are looking at right now, where that seems to be a spot to place money, as I hear regularly from big funds and institutional players that are looking to deploy into small bay. If you were doing it in 2011, that wasn't a hot commodity back then.
No, like I said, it wasn't like we were super calculated and figured this is going to be a great asset class. It was really how do we, you know, our capital historically has been very personal. So a lot of our investors are, friends and business friends. And a lot of our investors come from the real estate industry, which is great because a lot of times they're great sounding boards. We have, very smart people who invest, who are either running and operating companies or have been longtime investors. And so, we get a lot of really good feedback from our partners. And I think when we first started, really we were looking at how do we make sure we don't lose someone's money and hopefully we're going to make a return on it. And we felt like this asset class, because you have such a diverse tenant mix and you weren't going to be beholden to, a given tenant on a building. That was really the attraction for us. And then the asset class with the kind of replacement cost um, metric, even to this day, has always been there where you can't replace this for what you can buy it for and fix it. And I think that's probably what's been the catalyst for a lot of the institutional investors is they recognize that dynamic. And then, similarly, you get great risk diversification with a broader array of tenants. And we have a chart somewhere that I don't have in front of me, but that shows the diversity in our rent roll. And so we felt like we have pretty good uh, risk protection, if you will, from the diversity in the tenant base.
Has your investment strategy changed at all in the last, I guess, there's so many variables to actually look at because you went through the great financial recession, you went through the 4-day COVID recession, and now we've got interest rates that started going up in 2022, 23, and now we're dealing with tariff issues and everything else that's with it. How are you adapting to all this rapid change that's coming at us? Does that change your investment strategy at all?
Yeah, it's a great question. I mean, I guess philosophically, not really. We're still trying to buy assets that have been, for lack of a better word, undermanaged. So a lot of these assets are owned generationally. They're still, even with as much institutional capital as flowed into the space in the last 2, 3, 4 years, and even a little before that. But it's still a very fragmented asset class. You don't have, a large institutional owner, a Prologis, a Blackstone, a Link that owns, a bulk of this. It's still owned largely, I think, somewhere in the neighborhood of 95% by inst- private investors. And they run the gamut from, sophisticated private investors to, someone who his fathers built them in the 70s, 80s, 90s, and they've inherited them and they manage them for cash flow. So a lot of times the capital needed to kind of raise rents to a market level hasn't been injected. And so, we'll buy something hopefully that has 25 to 40% below market rents, and we come in and inject the necessary capital in the form of roofs and landscaping, painting and asphalt and mechanical upgrades and, all the things you need to do to kind of try to get your rents to closer to market. And then, in a perfect world, we raise the rents to market and we sell it or refinance it. In our funds, they're closed ended, so we are obligated to sell. But historically, we have a lot of assets that we've just owned for decade plus, and have good financing on most of them, and so we just operate those and make distributions to our investors, and then the fund we're buying, fixing, selling. So it hasn't, our thesis hasn't changed. I mean, certainly the way we look at things has changed with respect to interest rates. We got caught on a couple assets in our first fund where our exit cap rates, in hindsight, were just too aggressive. But fortunately, early in the fund, we round tripped some assets where we meaningfully outperformed our underwriting. And so on a blend, I think still do well by our investors in our first fund.
Yeah, that's a great point on how the exit cap rate can change the variables on it so much, and if you are a bit aggressive on it, and I don't think anybody anticipated interest rates rising at the highest pace in 40 years, so quickly and so dramatically. So I think that did catch a lot of people. But if, in the benefit of having a fund is that if you have other assets that are blending it, then it's not as stark as if you just had one asset that you underwrote with an aggressive cap, and then when you go to sell it, if that was the only single investment, that can be a lot more devastating. So yeah, having a fund model makes a lot of sense in that regard to ease out any of the ones that perhaps underperform. What are you seeing right now in terms of deals being available? And assuming you're still chasing that small and mid bay stuff on the value add side, are there actually deals available right now, or are a lot of sellers stuck on 2022 pricing?
Yeah, I think it's kind of a combination. There are a lot of assets, ironically, that have come to market because it's the one asset class, at least in the markets we invest in. I think this probably holds true for most markets. It's the one asset class that hasn't been built. So we all know vacancies escalated, meaningfully depending on what market you're in over the course of the last 24, 30 months. You've seen a little bit of elevation in vacancy. We've certainly seen a slowdown in leasing velocity. We haven't seen rents erode, which candidly is a little bit surprising to me. I'm surprised we haven't seen that, but I think it's largely because there's no supply side pressures. There's just not. So most of the elevated vacancy in the Western markets has been driven by supply combined with, a slowdown in demand. But, if you didn't have such a overwhelming supply, I think those markets would be much more in balance. And so I think that's why we haven't seen rents erode in this product type like you have in the larger buildings, because it's really the only side you really have to look at as an investor is the demand. I mean, we don't even pay attention to what's coming on that could impact us, because if someone's building this from the ground up, which there have been a handful of it, so there's been a handful of guys who've done well on it, but it's very, 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 very few and far between cases where people have built this. And so we really focus on demand and making sure that we really think the rents that were achievable, and that type of thing. But we're not looking at, okay, what's the forward supply that could impact this? 'Cause it doesn't exist, and I don't think it will exist for a foreseeable future, candidly. Other than a few isolated instances where somebody has a really great land basis, whether that's a location that's so good that they can justify a premium of rents that development warrant. But it's definitely not been done at any scale. I don't think will be.
Yeah, I think that's one of the biggest stories right now in industrial is that you have the big box warehousing on one side, and then you have the small and medium on the other side. And the big box, you can go and build a new building and be competitive with the existing inventory, because that's a lot of that existing inventory isn't that old.
Yep.
So you can go in, especially in markets where there's unlimited land, like a Phoenix or a Dallas, where conceivably you can keep going in every direction. You can just keep expanding the industrial park. Whereas the small and medium bay, I've looked into this in details, at least in my market, and it was to actually go and secure land at market prices and build with today's construction prices, you'd need to get a 50% premium over what the existing stock of small bay was leasing for. So just arbitrary numbers, $10 a square foot to lease existing class B small bay warehousing, you'd need to get $15 a square foot to justify it. And for the tenants, they don't necessarily care if it's a brand new building or not. They just need a roof over their head so they can make their product or store their vehicles or whatever it is. They're not going to pay a 50% premium in rent just to have something that's new when they don't really care about it. So I agree with you. The supply it's very challenging. Everybody wants to build small bay. That's a comment I hear all the time. Everyone wants to develop small bay, but it's very difficult to actually make those numbers work. Do you see that changing at all? Do you see a uptick in rental rates on that small bay to perhaps get closer to that cost of construction price?
From your lips to God's ears. I mean, it's so our existing product will be in pretty good shape. I really don't. I know. I think there are isolated cases where tenants that have a real image issue or something are willing to pay a premium for newer product, and we try to come in and take older product and make it look newer. And there's limitations to doing that, right? I mean, there's certain things you just can't change, or it's not economically feasible to change. But you can do a lot with landscape and paint and, updated asphalt and curbing that will get you, I don't want to say a premium, but will certainly get you to market or get you a competitive edge against older stock, where you've come in and renovated it and white box the units and made them functional and spent the money so that, these tenants won't wait 6 months, which is effectively what it takes to renovate a space if you're permitting it, which you usually have to, and going through the various municipalities. It takes 6 months. A lot of these decisions tenants are making decisions, over the course of weeks or a month or two. So our strategy is to get the units into what we think is the most sort of generic or widely, uh, I don't know what the right word is, but it is appealing to the broadest tenant base. And then beyond that, we generally don't make additional improvements, unless there's a big balance sheet or something that really warrants it, where we're comfortable that we'll get the return on that additional investment. But for the most part, we're white boxing them, painting the warehouses, redoing flooring in the interiors, trying to come up with a site plan or floor plan that's, as generic as possible and attractive to the widest array of tenants, and then we just kind of stick to that.
Do you do LED lighting as part of the white
We do.
box?
Yeah, generally almost every time for the most part. Sometimes we have existing tenants. We're not coming in and doing it proactively, but anytime we are turning a space over, we'll always come in and put LED in our house.
Have you found a common budget based over a large number of properties on what it costs you per square foot to go in and update an older Class B industrial space into that white box? And I don't know if that would include the asphalt and curbing, and maybe you need to do some roof work in there as well. But have you found that there's an average square foot cost you pay for renovations?
Yeah, it's a great question, and the answer is kind of. Yeah, I think every market's different, and every project you buy is different. We've bought projects that were basically industrial buildings that had been converted to office over time, and we come in and take out as much of that office as we can. You saw a lot of office creep in this product over the last 30 years. Tenants would bootleg some stuff in, sometimes landlords would build it, and over the course of the last, call it 10 years, maybe 15, you've seen a reversal of that. So the broader array of tenants is looking generally for lower finished spaces. And so it just depends on what you're taking out. We do have, our asset managers and acquisition guys are probably better to answer that question than I am, but we do takeoffs when we're doing our budgets, because we know what it costs to do asphalt. We know what it costs to do roofs. Landscaping, we generally, get a landscaper out there, because it depends on how bad the existing landscaping is and what you're going to do. But generally, we're using takeoffs for budget, and then if we go under contract, then we have our vendors do a full deep dive and really try to hone those numbers to make sure that our budget numbers are something that we can, live with. And if not, then we have to either adjust our budget or try to get something from the seller if there's something that wasn't contemplated in our initial underwriting that we discover while we're doing our, more thorough due diligence.
Yeah, that makes sense. Yeah, and I agree. There's not as much of an appetite for built out office space as there was back in 10, 20 years ago. I'm seeing anywhere from 20 to 30% being somewhat common for
Yeah.
at least for small bay. If you're getting into the bigger mid bay, it's probably even less than that. But if you're talking a under 10,000 square foot bay, that 20 to 30% seems to be common. Is
Yeah.
that what you're seeing?
Yeah, exactly. That's what we try to adhere to. Sometimes you're forced to be like closer to 30. If we can get it, just a lot of times it's where the bathrooms are, and you really want to, to recreate bathrooms. We all know it costs a fortune. So sometimes you have a little more than you probably would ideally if you're starting from scratch. But it's a function of, do we still think there's a, tenant base that will lease that space? And those are just, decisions you make kind of day to day. But no, I think 20 or 30 is that's what we strive for.
On the topic of the tenants, because I think this is a topic that doesn't get talked about enough, and I think it's the biggest surprise that the big institutional guys would face once they start getting into this, is that you're dealing with small mom and pop tenants, and they're non-credit tenants, and it's a mom and pop shop. I posted a picture on Twitter the other day on a small bay building where a truck basically parked on the fence there was a chain link fence, and they basically parked on the fence. So the fence was like 45-degree angle. And when we were trying to find out who it was, all the tenants were like, "Oh, it wasn't me. I don't know whose truck that was." So we still haven't even found out whose truck this is. So you're not dealing with FedEx. You're not dealing with these large companies. You're dealing with gunslingers a lot of the time. And there, I really like small bay tenants for the most part, but you do run into some that perhaps don't treat the building as well as you would like. And then you couple it with the fact that they usually prefer short-term leases. They will go in some cases and do a 3-5 year lease, but a lot of them want short-term leases because they all think their business is going to double next year. So that comes with some inherent challenges. How do you get around that? Do you just accept that as a risk of being in that asset class, or do you have a system to work around that more effectively?
Yeah, welcome to my world. I think it's the management is super granular. So, you know, eh, this may sound self-serving. I think I feel like we're always going to be better than a large institution that's managing this with third party management. I mean, we're very hands on, and you have to be. You have to make credit decisions largely on FICO scores. I mean, truly, like a lot of these guys don't know what a balance sheet is. Might get a tax return and a FICO score, and they're not making any money. But a lot of them, they're operated as S's or LLCs, and they're running stuff through the business. And so, even if you do get a income statement or balance sheet that shows some decent assets, it's all pass through. So generally we're trying to get personal guarantees to mitigate some of that risk. And then it's just management. We're fortunate we have, great managers in Southern California and Vegas. We do our own property management, and they interact with our asset managers literally daily, hourly, dealing with these issues. Is this tenant paying? Is this guy overburdening the parking? Is, someone parking in front of someone's roll up door? It's like, they're sort of refereeing schoolyard fights in some cases between tenants, but they do a very good job. And then we third party manage in the rest of the municipal or the rest of the regions that we invest in, so we don't have a deep enough footprint to do our own management. And we've been fortunate to have good property management partners that interact very closely with our asset managers. And so they're making those credit decisions, those tenant decisions, those TI decisions, literally on a daily basis. But it is, we our lease form. We have a standardized lease form that we use. That's an AIR form with an addendum, and so it's I think some institution will come in and give them a 10 to 60-page lease, and their eyes just glaze over. They don't even know what to do with it. So, we try to keep it very simple. We try to keep all the modifications to the lease in the addendum, so that our leasing people and our asset managers, property managers, point to the tenant and say, "Here's the changes to the base form. If there's something that you object to, we can certainly have a discussion about it." But by and large, I'd say, I'm making this number up, 90% of our tenants sign the lease as is. And then we have, we have a segment of our tenant base is more sophisticated regional and national companies, and then they get involved with, their attorneys and whatnot. But that's, like I said, probably somewhere in the neighborhood of 10% of our tenant base.
Yeah, so you're in the weeds getting your hands dirty with these tenants, which I think is the biggest surprise that
You have to.
any
You
if
absolutely
it,
have to.
you have to. Yeah, I couldn't agree more. So if there are any institutional landlords listening and they're thinking about getting into small bay, there's a huge difference between a single tenant building leased to FedEx on 15 years and a 50,000 square foot multi-tenant bay leased to 20 tenants with lease terms ranging from month to 5 years. There's a huge difference. Even those buildings might be priced the same, there's a big difference, and it's not passive. I think that's the other thing as well, is that FedEx building, that might be a passive investment, but the small bay is not. There's a business element to it of having to do that ongoing management that's so imperative on that. So I think that's a great point on that. Have you had to deal with many evictions, or how do you deal with tenants that just inevitably get behind on rent?
Yeah, I mean, we deal with it daily. And it's, our decision making is very different, based on geographies. There's clearly some states that process is brutally long, and if someone knows how to play the game, they can string you out for 6 or 9 months. But you just deal with it. So there's other municipalities where you put a note on the door and say, pay the rent in 3 days, and if you haven't paid the rent, we're going to change the locks. And so in those municipalities, we'll probably take a little more credit risk than we will in the municipalities where eviction's so difficult for that
Mm.
reason, just because you can get tied up. So sometimes, in a place like Vegas that's much more landlord friendly, we might take a little more credit risk and try to get increased security deposits to mitigate, the 60 days or whatever it takes to get someone out. In a place like California or Seattle, we're much more carefully scrutinizing the credit risk we're taking, and less willing to take credit risk because the eviction process is so much more convoluted and difficult and lengthy.
On the personal guarantee front, I know that a lot of landlords are very hesitant to actually enforce that personal guarantee if it gets to that point, for the reason being that if their business has failed, they've probably bled out their savings. There might not be anything actually left to even go after that personal guarantee. And even if there was something, even if there was enough to recover, a lot of landlords just take the position that I don't want to go after, and these guys have already failed in their business. I don't want to try and take their house next. What's your position? I know that's a very delicate question to answer, and it's probably case by case, but have you found that you've enforced many personal guarantees, or what happens if it gets to that stage?
Yeah, you're right. You're absolutely right. I mean, generally, the personal guarantee is more of a kind of a hook to get someone to really make sure that they're going to try to pay if they have the capacity. But you're absolutely right. I mean, in most of the cases, you can't get blood from a turnip, and so it's just we try to, when we feel like there's not any meaningful recoverable assets, we basically just try to say, hey, give us the keys, don't belabor the point, and we won't chase you. So if someone is obstinate or non-communicative, or just refuses to pay and isn't communicating with our property and asset managers, then we have chased personal guarantees, and we've collected on a few. I mean, I think probably over the course of my career we've maybe collected on not more than 10. So, and we probably had hundreds. So that gives you an indication. But there are cases where you have a guarantor that has meaningful net worth, and the business fails, and sometimes it's a guarantor that's not the operating person of the business but the captain of the business, and so
Mm.
that has a decent balance sheet. And we have collected, in any location you have an obligation to mitigate damages. You don't really know what your damages are until you get the space back, renovate it, and release it, and then you can quantify them. And at that point, we have chased. We make a calculated decision: is this someone who has assets, and we're not going to cripple them and take their house, like you say, but they owe us the money, and we have collected. But the lion's share of the cases, it's like, just give us the keys back. We won't chase you, but don't squat for 6 or 9 months. And if they choose to squat for 6 or 9 months and are not communicative, then we take a little different position. It's like, hey, we kind of gave you an out, and you chose not to take it, so we have to enforce what we're entitled to contractually.
Yeah, I mean, people can't underestimate the fact that a landlord is giving a leasehold interest to the tenant. They're giving them something. So by not paying, they're breaching an obligation. So it'd be the same as if they had a contract with a bank, or they had a contract with a lawyer or a service provider. People need to be compensated for what they're given in exchange. So yeah, I agree. I think those scenarios where tenants are taking advantage of the situation, then that calls for an appropriate response in that measure. How often would you say that that's happening? And again, I'm asking for like a percentage when it's probably very difficult to have, but how many if you were to have 100 leases, how many of them do you think would go the whole way, all the way to fruition, versus how many might have issues along the way?
Yeah, I mean, fortunately, the bulk of our tenants are good people. Good, they run good businesses. They have different margins, and some make a lot more money than others. But most of them pay rent. I mean, obviously, we're not dealing with 10% evictions, and it kind of
Mhm.
depends. The more granular, the smaller bay, the more fragile that tenant base tends to be. When you get into mid bay stuff, usually they're a little more established business, and so this is just a guess, but I would say maybe 2%. We do look at, with our asset management team on a monthly basis, we look at AR, and we run comparative. Um, we look at our AR over an extended period of time, and we look for fluctuations in that AR. And if we see any meaningful increase in AR, usually that's a pretty good leading indicator that you're going to have some problems. Um, but we and frankly, I expected more throughout the course of this last year and a half, but we haven't seen any meaningful elevation in our AR, over the course of the last 3 or 4 years. It kind of fluctuates up and down a little bit, but from a trend perspective, we haven't seen it. I candidly am a little surprised. I thought we'd see more, but what I hope that means is that our tenant base is more resilient than I think maybe the general perception of this type of tenant is. And it's proven to be resilient. I hope that'll continue to be the case, but it certainly has been the case, even through a pretty tumultuous period in industrial real estate. And to your earlier point, the tariffs, and prior to that, the interest rate increases. There's been a lot of headwinds, and we still haven't seen a meaningful increase in, you know, delinquencies and, our AR balances. So, I think we feel good about that and hope that it continues. I don't have a crystal ball, but I do think over if we haven't seen an elevation over the course of the last 24 months, my hope is that we're not going to see a meaningful increase going forward unless we have some major kind of catastrophic black swan event or something that's hard to business plan for those kind of things.
Yeah, I asked that because we did talk enough about evictions in the process that I didn't want to make it seem like this is a very common event. It is small, so it's something that happens. I think everyone needs to be prepared on how to deal with it, but it is a small percentage of an overall portfolio if it's done correctly. I think the one thing that I'm really optimistic on the small bay stuff for is that because there's a confined amount of space and it's so difficult to actually add new space, is that also inherently limits the competition within the business community. So if it was economical to just go and build a 40,000 square foot building right now, then I think you'd have all these people being like, oh, I could start an HVAC shop, or I could start my own plumbing business, or I could start my own electrical distribution company, or I can start this. I think you'd have a lot more people wading into it, and then that functionally creates more competition for all these small businesses. But because there is a confined amount of space, the competition is just inherently restrained. So I think that it helps the landlords, because then we're facing less competition for tenants trying to take space, but it also works within the tenants themselves where they have less competition. So I think even though that it has been a bit of a difficult time, there's still a huge need for all these services. I bet you in every city, it's still very difficult to get an electrician right now. It's still very, especially if you have small one-off jobs. Whereas I think if it was the opposite, if we had all this big box space, then I bet you there'd be electricians saying, "Oh, we'll work for free. We'll do the first one for free just to earn your business." So I think that's actually a really compelling narrative for the future on this as well. Is that the businesses, and if they're mom and pop businesses or small local companies, this is their livelihood. This is what they live for. Literally what they get up in the morning to do. So they're very committed to try and see this through. So I would have thought that there'd been some more distressed companies as well, but the resiliency is pretty remarkable. Do you what's your thoughts on the future going forward with that? Do you see that this a sustainable business model for the foreseeable future, barring that black swan event like you're seeing?
Yeah, it's an interesting point. I honestly haven't ever thought about it from that perspective of the limitation on supply. I mean, creating theoretically a limitation on business development, I guess, or new business development. So, I mean, it's an interesting point to bring up. I haven't really ever given it a lot of thought. I think we do have startup businesses a lot, and a lot of times it might be a guy, to your point, that's been working for another electrician for 10 years and has developed a skill set and feels like he can go branch on his own. And a lot of times those guys don't have many assets, and it requires our leasing people and interacting with our asset managers and property managers to make decisions like, do we think this can succeed? And again, you're making a credit decision based on a FICO score and that type of thing. But I think your point about finding vendors in this environment being difficult is absolutely true. Like, one of the things we really struggle with is getting our TI costs quantifiable, and you can't come in and bring in the big general contractors to paint and carpet and move a couple of walls job, where it's a cost you a fortune. So our property manager and asset managers, and most of the markets we invest in, have done a very good job of finding kind of the, for lack of a better word, down and dirty contractors that work on these small jobs. And in some markets like Vegas and Southern California, we have enough of a base that we can keep these guys pretty busy just in unit turnovers and things like that. And so we do have some good, lower cost providers. But you're absolutely right. Finding an electrician, finding a mechanical contractor, finding a painter, it's not easy, and especially for these small jobs because they're maybe if you're spending $10,000 to renovate a unit or something, you got to do a lot of $10,000 jobs, as a contractor to make margin. And so, we try to find those guys and try to be loyal to them and try to keep them busy enough where we're not calling them every 3 months saying, hey, we need another $10,000 job. They're kind of cycling in a lot of cases from one project or space to another, over the course of a year, 2 years, 3 years.
On property level specific, just changing gears a little bit, what are you looking for on the bones of the building? And I guess I'd tee that up by saying these small bay buildings typically don't have a very large marshaling area, so they won't have 130 feet at the back where you can comfortably navigate a semi truck in there. It's shorter. I've seen some even that have as low as 50, 60 feet where you could basically just get a small commercial vehicle in, or maybe even just a normal passenger vehicle. Are you looking at, are there things that you're looking at for the marshaling area and ceiling height, and location is obviously important, but are there things within the building itself that are perhaps red flags for you, that if it was a 50-foot loading court, you're just saying that's not going to work, we're not going to be able to get anything in there? Or if it's 14-foot ceilings, perhaps that's a no-go. When you're looking at a building, are there decisions that you make like that, or is it case by case as well?
I think it's case by case, and I think as it relates to clearance and truck access, I think it really depends on what we're talking about. So if you're talking about 1,500 feet, 2,500 feet, I mean, if they get a semi, which happens periodically, they're side loading and it's can be disruptive. But generally speaking, those guys are box truck delivery guys, FedEx delivery guys, and so it's less of a concern for us. I mean, we've actually had some, prospective institutional partners like, well, we can't buy anything below 20-foot clear. I'm like, well, you're not going to buy that small bay product. Most of the stuff's 14, 16 feet. And candidly, the small guys, they never rack high anyway. So we're less
Hmm.
concerned about a 14 or 16-foot clearing building if it's functional, the loading's still, reasonably good, and the units are small. Now, when you get up into 10,000 feet, even 5, 7, 8,000 feet, then you start getting tenants who maybe had a little more of a distribution component to them and often and might be getting semis more frequently. And so, then we're paying more attention and saying, okay, a 14-foot clear building that's 20,000 feet with, loading that's not great, that may need, harder space to fill. So I think it depends kind of on unit sizes and kind of who you think your tenant base is. We own a lot of, we own several projects that are, have small bay, but with like 2 docks and a grade. And that product probably of everything we own is the best. I mean, anything, if you can find 10,000 under 10,000 feet with 2 dock, even 1 dock, but 2 docks and a grade level door, that stuff almost never goes vacant. And when it does, it's someone moves out, we come in and we have a new tenant in a month or two. When you get to 10,000 feet with just grade level, and maybe to your earlier point, the loading's a little compromised, that's more challenging. So I think, it's probably a roundabout way of saying, we look at it differently depending on the size of the tenant, the location, and who we think our tenant base is likely to be.
I couldn't agree more with you on the point of having a sub 10,000 square foot bay with dock and grade loading. It's almost a unicorn. They
Yeah.
do exist, but they're so rare and it's difficult to come by. What's more common is that you'll see 2 or 3 grade doors, or perhaps 2 or 3 dock doors, but to have the combination of both just gives so much optionality to the tenants that it's because a tenant could probably work with even a single one of either if they had to, but to give them the option of being able to use both, to accept a semi access and then also a delivery van and bring things in and out, that's a gold mine. So if anyone's listening, they want like a good option to look at, is find a building sub 10,000 square feet with both. Anything else in there, or do you start looking into the power? Do you start looking into, obviously there's going to be the roof and the asphalt and like the big capex things that you'd need to be spending money on, but beyond that, is power an issue, or are you just prepared to invest in the space providing the numbers make sense?
Yeah, that's a great question. And candidly, power is something that we didn't pay a ton of attention to when we first started because some of these units only have 100 amps. We generally try to get 200 amps for the small units, but I do think we've been hearing from our leasing folks, and I've been hearing from our asset managers that there's been more frequent requirements recently that have a higher need for power, whether it's 400 amps or they need three-phase power. And we're actually going through this process in a project we've owned forever in Riverside, where we have one building that's just power constrained, and so we literally can only do like dead storage. So we're in the process of trying to work with the municipality. It's a city-owned utility, and get an upgrade. It's taken forever. I think we're getting closer, but I think power is something that will certainly. I hear from my friends who are more big box investors and developers. They're really seeing power being one of the primary constraints to new development, because it's just with everything going on with data centers, and you have a lot of some of the sophisticated manufacturing uses have much higher power needs than historically has been the case. And so I do think that's something that's going to be increasingly important, and something we'll probably be paying more close attention to than maybe we have in the past. But beyond that, we have a due diligence checklist that's 4 pages long, and when we go in, we try to do a very thorough job. So we have to get PCRs for lenders, but we don't rely on that. We send out roofers, mechanical contractors, electricians, structural engineers. We camera the sewer line. We send plumbers. We do a structural evaluation, if I didn't say that, on the building. And so those are all to address what could be potential deficiencies. But the things that are static, like clear height and truck circulation, loading, you can't do anything about that. So you just have to evaluate whether what you're buying is still attractive to a large enough, range of tenants to, make the investment.
I don't want to go off on a tangent on this, but just on the
On
power side, because I find this so fascinating. I think that this is the single biggest issue that's coming our way right now. And when I look at China, who's leading the world in solar installations, they're leading the world in coal, they're leading the world in new nuclear installation. They're preparing for an energy war right now. And in North America, we're doing the opposite. We're trying to shut down coal. We don't have any plans for nuclear. Solar seems to be a slow adoption, whereas the massive increase in power, everything's being electrified. So semi trucks are heading that way. Passenger vehicles are heading that way. Equipment's heading that way. Everything inside the space is going to be electrified in the near future. And that's why I think power demand is up so much. And all these developers are saying we need to try and get ahead of this. But our power supply is waning.
Yep.
And I think this is another thing that's on the back of my mind is any city that has a big data center in the process, I think that they should be very careful on what happens, on whether they're even going to be able to get additional power. So from the one site that you have as an example, if that was in a city where a new data center is going in, that data center is going to draw so much power, and they're going to be the number one client of the power company. So they're going to get first dibs on any power that they want. Whereas that small local owner, if he wants to get power, maybe 5 years ago he could, but if that data center is going to gobble up so much power, it might be difficult to actually increase power. So if you're in a city and you have a property right now where there's a potential for a big data center, try and secure that now, because it might get to the point where there just isn't enough. And I know that they can do on-site power generation in some locations, but I think a lot of it is still just going to draw on the traditional grid. And I just think we're heading in the next decade, if something doesn't change materially, I think we're going to be in a real power imbalance where the small guys are at risk of not being able to increase power in a time where tenants are demanding more power. It makes sense. Like, am I out to lunch on that, or do you
No,
see that
I
being a
think
concern?
you're absolutely right. I mean, candidly, I think you've probably researched this more than I have. We've just started seeing it more anecdotally, and so that's an indicator, right? I mean, we rarely had tenants that said, "Oh, I need 400 amps on a 2,000 foot unit," in the past. Or if we did, I didn't hear about it too much, but we are starting to see that. I think you're absolutely right, and I think I'm not up to speed at all in the data center space or what I read, but yeah, clearly there's been a huge proliferation in data centers, and you've even seen some of the large, the Metas, Googles, whatever of the world's, talk about building literally building a nuclear plant to power these data centers. And I think there's going to have to be creative solutions like to that, because I agree with you. There's not going to be enough. The utilities are all, primarily way behind the eight ball. And so like, oh, well, we need to build a new substation. So we can bring you that power, but it's going to be 6 years from now. Well, that time horizon doesn't work for developers and investors. And so, I think you're really right. It's probably something that we should pay a little closer attention to on our portfolio and say, okay, are we underpowered on these, and which projects can we bring power in, in a economically feasible manner so that we can attract a larger range of tenants that have that need. But I think you're spot on in terms of power is not going, we're not going the other way. Like you say, everything's being electrified. You have more sophisticated manufacturing that requires more power in a lot of cases. So I think it's going to be an issue solution to it, but I think you're right. It is going to be an issue.
Yeah, the
Yeah,
solution is way above my pay grade. It's just one of those
give me
things
both.
that, I'm very fascinated with, and I do think that it's gonna be an issue, so I follow it way more closely than I probably should. Are there any other trends that you're seeing in the industrial space? Anything that you're following? And that could be on a company level, on just what you're seeing within the workforce or your various tenants, or within the building or within markets. Any trends that you're following?
Um, I'm not really sure. I think we we're still optimistic. I think we've talked a lot about this, but I think just the lack of new supply, I think, will think and hope that the elasticity in the rents for the smaller bay project, I think, is going to outpace the big box product, and it has over the last course of years. If you look at trend lines, I don't remember the exact dates, but 2020 to 23, big box rents went up depending on the market you're in. 50%. I mean, some cases,
Hmm.
rents, guys paying old rents were faced with renewals where the rent's doubling or even tripling. We didn't see that. There certainly were some cases where guys had super low rents that maybe a landlord had done an as-is deal and they got a 5-year deal at 55 cents, and now the rent's a buck 30 or whatever the number is. But it's really more isolated. Most of the guys are coming off of paying a buck and we're getting a buck 25 or something like that. So on a nominal dollar basis, it's not a huge when you're talking about 2,000 feet. And there's no new supply. So the only place a tenant's going to go is to another existing building somewhere. And we very much try not to lose tenants to relocation for less expensive rent. Just it doesn't make sense for them. And if in reality we think the rent's a buck 30, but there's four options for this tenant, the buck 20, and they're substantively similar, we should do a deal at a buck 20 because it doesn't make sense for us to lose a tenant over a dime if they have four options that are a dime less. Now, if they're significantly inferior or whatever, sometimes we'll hold the line, but your cheapest tenant is always your own tenant. It's always less expensive to renew a good tenant than it is to retenant. Almost always than retenant the space and find someone new to pay similar rent.
Yeah, and you never know what you're trading them out for. You
Yeah,
might lose a tenant over a nominal decrease that you'd have to give them, but what tenant do you replace them with? Are they as good of a tenant? Do you have those eviction issues and things of that nature? If you have a tenant that you know is paying their rent and they've been a good tenant, it's almost always better to take a little bit of a haircut to keep them in there.
yeah, I would agree. I mean, the only scenario where that calculus changes a little is if we're we about to sell the project, and if that rent would be overly dilutive to NOI, and if we're capitalizing that, sometimes we'll make a little different business decisions on that when we're positioning something to sell. But by and large, you're 100% right. I mean, it doesn't make sense to lose a good tenant competitor at a slightly lower rent because it's always a little bit of a chess game because it's expensive for tenants to move, but it's also expensive for us to re-tenant the space. So there's always that sort of a little bit of an arm wrestling. But I think by and large we do a good job retaining our tenants. We certainly try to, and I think over the course of our history, we've definitely outperformed the retention ratios that we underwrite. So we'll continue to underwrite relatively conservative retention ratios, but with the hopes that we'll outperform that. And historically, we've been able to do that.
Hmm. Are there any deals or projects that you've done recently that have fired you up, gotten you really excited, or any in the hopper? Any deals? I guess I'd ask has just got you really excited.
Yeah, we bought in our second fund. We bought four assets. Two of them are industrial condominium projects. One in San Francisco, one in Carlsbad. And it's interesting. I think I was at a CD regional logistics conference, and it was interesting to me because I didn't really realize this, but the number of owner users buying bigger buildings, not what we own, but bigger buildings, has really been a pretty pronounced trend. and it's come at a good time for the industry because we all know that the capital markets are still a little more challenging, and rents, cap rates have certainly gone up, but users are paying a premium again, and that's been the case through my 35-year career. There was almost always a user premium, except for that window from
Mhm.
2020 to 2023 when investors were paying, buying stuff at three caps, and it did, that went the other way. So you had an investor premium, which I'd never seen in my career. That's reversed itself. It is reversing itself. It has reversed itself, and so I think we're pretty bullish on both these projects. Had the condominium maps in place. There was no discretionary approvals, and we've executed on this business plan quite a bit over the course of our career. Or most cases, we are buying distressed business parks passed to the banks, and then we reform the association and set up the CCNRs and all the REAs, and we sell off the buildings individually. And that's our business plan in those two. I'm pretty optimistic. I think we bought them at reasonable rates, and I think at reasonable values, and I think there's a user premium that we'll be able to achieve over the course of that. And so I hope I'm right, but yeah, I'm looking forward to that. And it's a lot more work when you're fractionally disposing of a project, right? By 100,000 foot project, you got to sell 25 units. You got to make 25 deals to get out. But I think, in our view, right now, we think there's enough of a premium there to warrant that additional work.
Well, and that's an underrated element of the business as well that few people talk about is that there is the opportunity for small users to go and buy their
Mhm.
own real estate. And industrial is unique. There's no other asset class compared to office or retail where the companies love owning their real estate. And there's the opportunity to do so as well. I suppose there are some office condominiums and retail condominiums, but it's not nearly as prevalent in industrial, where especially on the bigger stuff, like big companies love owning their own real estate. Whereas you're not going to find Walmart or Costco or Home Depot. They typically are going to be tenants. Industrial companies love owning their own real estate. And just as there's a shortage of small bay product to lease, there's a shortage of small bay product to buy because there just isn't a whole lot of them. And if you wanted to build something new, you need that same corresponding premium to justify it. So I think I love that idea of taking a building, and some people have successfully taken a building that wasn't even condominiumized or strata titled, and they've taken it and they've gone through that process of
Yeah,
doing it.
we've done that. Yeah, we've done that several times ourselves. The appealing thing here was it was already done. And
Yeah.
again, getting back to the municipality, that process is much more difficult in California than it is in Nevada. Nevada, if you have a commercial subdivision on top of it, it's an administrative process. And so we've done that, successfully several times. But the process is more difficult in a place like California. So having a map already in place where there's no discretionary approvals, in our opinion, has a big benefit, because there are conditions if you're trying to do that in some municipalities where you have to bring everything up to ADA, or you have to meet current setback requirements, and it's just not feasible in a lot of cases. You literally have to lose GLA or lose parking or lose whatever in order to comply with current codes. So having a map in place in a more difficult regulatory environment is certainly a benefit in our view.
If you're up for a second episode down the road, I'd love to explore the idea of industrial condominiums more because I know very few people are talking about it, and I think that there's a ton of opportunity in that space. So if you're up for it, I'd love to do a deep dive into that in a future episode.
Sure. Yeah, I think what we've seen, to your earlier point, tenants went through such a sticker shock on rents,
Yeah.
over the course of the last 3 years, and so while interest rates being elevated doesn't help the dynamic, I still think there's a compelling philosophical element to tenants being able to control their operating costs and say, okay, I buy this. Maybe my occupancy cost doesn't compare super favorably to rent day one, but over the course of a 10-year horizon, if I'm looking at it that way, I'm going to basically get the depreciation, the interest write off. Most of these guys buy it personally or in a trust and lease it back to their company. So the company takes the write off, they get the depreciation, they shelter, some of that income, and they're getting, hopefully asset growth over the course of that 10 years. And so if you, depending on how aggressive or not you are on what you think what you think values will go up by on an annualized basis, it's usually still compelling over a 10-year time frame for people to own their building, or their unit, if as long as they feel like their space needs are somewhat static. So the companies that are in like hyper growth mode, or are their their revenues fluctuate dramatically, they're generally not buyers because they want the flexibility. But there's a lot of companies that have been in business a long time. They know what they do. They make a good living. their space needs are relatively static, and they're great candidates to buy a building and control their operating costs, for the foreseeable future.
Yeah. Well, let's tee up something in the fall. I'd love to dive into it
Sure.
more. Maybe we could even take a recent project that you've done as a case study and dive into it a little bit deeper because I think that that'd be very informative for a lot of people.
Yeah, we may in both cases. I don't know if we will, but we may have data points by that time. I mean, I think we're still we're still finalizing some improvements and stuff on both of those, and finalizing the association documents and things of that nature. But we may have some data points by that time to talk anecdotally at least.
Oh, I'd love it. I think it'd be very informative for people to dive into that more. Anything else that just as we're near the top of the hour here, anything that I haven't asked you that you think is worth stating at the end here?
One of the things on your comment was, what advice would you give to someone who's starting out and wants to end up in
Yes.
your chair someday? I don't know why anyone will end up in my chair someday, but one thing I've really learned over the course of my career is finding good partners and good team members that complement your skill set. So, my partner handles all of our back office. He deals with pours through loan documents, pours through purchase agreements, handles all of our HR, deals with our accounting team, and does, make sure the trains run on time. And he's great at it. I would be terrible at it. When I started off, I tried to do it all myself, and I did that, ended it terribly. I'm much better on the business development side, on the deal evaluation side, on the disposition side, working with our asset management team and our acquisition team, and so that's where I spent the bulk of my time. And we joke that if he and I had to switch roles, we'd be broke because he's not good at what I am good at. I'm certainly not good at what he's good, and so I think finding complementary skill sets and building a team with people that building a culture. We try to keep our company corporate culture pretty, I don't know what the right word is, lax. We try to hire good people, give them good direction, and let them go do their job. And it's not always easy. I'm kind of a control freak by nature, so that's something that I've learned to do better, I think, over the course of my career. But I think it's very important. It's contributed to our success. We've been very fortunate not to have. We've had very low attrition rates. We've hired, yeah, ironically, we've hired a lot of my friends' kids who've all worked out great, and so that's been a great resource for us. But that's one thing that I think I've really learned over time is hiring good people, getting good partners, and having defined roles that are suitable to someone's core competency, if that makes sense.
Yeah, that's very well said. Just to tack on to that, incidentally, someone said this to me the other day. If partners aren't adding value to your business, you have the wrong partners. So I think that's a pretty good summary of what you said more eloquently is surround yourself with the right partners and the right team. And I think that is very important. So great
We,
words.
we've been very fortunate in that respect, where we've just, for the most part, not 100%, but we've made good hiring decisions, and we've hired people with good work ethic, and they're smart and they understand it, and they're quick studies. And so I think being able to continue to grow our organization and not lose that element will be important to us going forward.
If there's a broker or a potential seller listening and they wanted to reach out and perhaps put a deal in front of you, what's the best way to do so?
You can send. I mean, I can forward you the email of our two acquisition team members, Jason Mager and Michael Malady, or they can send it to me and I can forward it on. But they usually are doing, they're out pounding the pavement and talking to brokers, and trying to find. We generally trying to find stuff, if we can, that's not broadly marketed, because
Mhm.
a lot of times by the time there's a glossy package, and we deal with all the capital markets brokers, and they're great at their job. Unfortunately, sometimes they're too good at their job, so it makes it hard for us to buy it. So we've had more success with kind of like generational sellers. It's like, I've got a bunch of vacancy, I don't want to spend the money, maybe I'll sell it. And a lot of times it's kind of the leasing folks who have a relationship and maybe done the leasing for them, and they're like, hey, we've got someone who'll buy it. And so that's candidly where we've had our greatest success, is kind of finding stuff that's a little below the radar screen, and that's where our um, acquisition guys really spend the bulk of their time, is trying to uncover those types of opportunities. And so I can either forward it to you after, but that's probably the best place to start is with those guys. Um, and then
Yeah.
if
Oh,
it has legs, then we obviously try and really dig it in.
yeah, if you want to send it to me after, I'll put that in the show notes so people can reach out to your acquisition
Yeah,
guys. And I'd encourage someone, if you have an off-market deal that you think makes sense, send it over to
please,
MCA.
please
It's
send it.
yeah, I know that in your space you always just want to look at deals, and sometimes it's a quick no, but I think most people want to look at more deals than less deals. So if you have something, shoot it over to Tim, and maybe you guys can get a deal done.
Yeah, and
Well, yeah. Oh,
I think just
sorry.
for what it's worth too for the audience, our decision making is very quick. Yeah, the investment committee is me and my two partners. We don't have anyone outside we need to go to. Our capital is discretionary. So if we say we're going to do it, we'll do it unless something comes up in the due diligence or interest rates materially change or whatever. We don't have to go get outside approval to make an investment. So I think that's powerful at brokers, meaning our capital's discretionary and our decision making is us. And so I think, I think that would hopefully is a positive to brokers is knowing there's not layers of decision making that I need to go through to make an investment decision.
Yeah, I think that moves the needle for a lot of guys. So, yeah, I'd encourage people to connect with you and present any deals, and look forward to doing a deep dive into industrial condos as well. I think that'll be
Yeah,
very exciting.
look
But
forward to it.
just
I'm
wanted
gonna
to
have to
say thank.
educate myself a little further with our asset management team to make sure I'm up to speed, but I thought I can probably do that before the fall.
Yeah, that sounds good. Well, if you want to bring an extra person on as well, then we could certainly accommodate that too. So we'll be as accommodating as possible just to have a deep dive into the topic. I think it'd be super fascinating. So thank you once again for taking the time to share all your insights in this. I love the conversation, love everything you guys are about, and really look forward to keeping the conversation going as well.
Yeah, I appreciate it. Thanks very much for having me.
Okay, thanks a lot, Tyler.
Take care.
Okay, take care.